if somebody scrapped together some money and wanted to side hustle this thing, and say they're a dual income, they make a couple $100,000, they've saved some money, maybe they have some inheritance money from a parent that passed away, and they try to buy that strip mall and they think it's a good deal because they like going to the 7-Eleven that's in it, and that's a good tenant. They ain't going anywhere. Your advice would be, don't even mess with this shit.
Don't even consider it. Get into an apartment deal, because what happens there is a lot. They save up that $200,000, and that's all the money in the world, and they're excited because they bought $1 million deal. Well, what happens a lot of times is then both tenants or 3 tenants all go bankrupt, or they just don't pay. Whatever it may be, right? The world is protecting the tenant. So then, boom, they got the $200,000. They got nobody paying. So what happens now? Now the property that they bought for $1 million, they put 200 hard-earned $100,000 down. Boom, property now is worth 500.
Today's show is great for anybody that is into real estate investing or looking to get into it. We're going to be getting our hands dirty, and I have my friend Andy Sallee as a subject matter expert on the show to guide us. How you doing today, Andy?
Fantastic.
Good, man. Good. I'm glad you're here, brother.
Thanks for having me.
I'll give you the proper introduction in a moment, but I want to let the audience know that Andy is a friend of mine. We met while both living at the Trump Tower in Chicago. This was pre Donald Trump in politics. Neither of us were there. People always think, you live in the Trump Tower, you must love Trump. And whether we do or don't has nothing to do with why we live there. This was like 2011, I think, right, Andy?
Yeah, I was going to say, that was 11 years ago, dude, when I moved in that property. I'm still there today. We're aging.
I invited Andy to the show because real estate investing is obviously a popular area of interest. And he and I have compared notes over the years and have leaned on each other for advice from time to time. His portfolio in real estate is much larger than mine, but I should mention I do have holdings in this space on a more passive basis than how Andy participates. My real estate portfolio includes the Via Newport Beach Hotel, used to be the Newport Beach Marriott, an apartment development in Koreatown in LA, an apartment development in Minneapolis, another one in Azusa, California. And then I have a series of one-offs that I have bought and sold going back to 2002 when I first started. And let me start there before I turn things Andy's direction. I owned 15 or so properties before the 2008 real estate crash. Many of them had exotic mortgage features. Many of them were purchased with very little money down under no documentation stated income loans. All of them plummeted in value when the market crashed, but none of them foreclosed. They didn't foreclose because I had other income streams outside of real estate. I watched others walk away from their investments and create a personal credit crisis and ultimately play their role in contributing to the housing crisis nationally. I do not feel sympathy for people that are in that category. I don't gloat about it, though. I genuinely do think it sucked for them. But most in that position should not have been there in the first place. We can blame the banks and the lack of protection from the banks from the government. But most in this scenario put themselves in this scenario out of greed, plain and simple. And that's where I stand on that. The formula for overcoming a housing crash is simple. There are only 2 pieces to it. 1, don't overextend. And 2, make sure you have other income streams for protection on those rainy days that you think will never come. Andy, fully agree, kind of agree, or disagree with what I just said?
Couldn't be more on point, my man. I agree 1,000%. There's so many people that get into real estate, and you're right, they get greedy and they're over leveraged and undercapitalized. I went through 2008 just like you did. We went through it together.
Yep.
And I tell you, yeah, it was like, dude, if people move out, you got to cover it. The bank is getting paid no matter what. I couldn't agree more awesomely.
I've been doing some real estate investing, social media reels lately, and TikToks, and it's funny how people are like, 'cause I'm talking about leveraging, investing against a mortgage, especially
Yeah.
when interest rates were lower, and people are like, oh, 2008's coming again, 2008's coming again. Well, wait a minute, guys. I'm talking about using HELOC and investing to beat these 2% interest rates that we had a few months ago. What you're talking about is a housing. These are mutually exclusive ideas. And it's just funny. It's like, dude, if the market crashes, you're fucked either way, dude. Whether or not you're foreclosed or not, maybe is different, but you're still
Right.
screwed from a net worth standpoint. But anyway, I digress there. Let me give you a proper introduction, Andy. Andy Sallee is a real estate investor with over 128 million in assets in his portfolio. He's focused not only on continuing to grow his real estate, but also give back to his community. He has started a nonprofit, Andy's Kids, where his mission is to provide food and other items to the homeless. I invited Andy to partner with me on today's episode because this guy has seen different facets of investing in real estate, starting with single family homes, then apartments, and now commercial properties and healthcare facilities. Andy, officially now, welcome to the show.
Thank you for having me, my man.
Yeah. And I told myself I would not be dropping any F-bombs on this episode because Andy is a spiritual man in nature. So
That's okay though. I do too, dude. You go to enough Tony Robbins event, that word's used a lot.
Yeah. Well, you know what? I wanted, that's one of the first things I wanted to talk to you about. And you talk about a guy that's always trying to level up himself. Okay. A guy that's setting his own standards and going upward every time. I'll tell you right now, like we already mentioned, we first met at the Trump Tower. And years passed since we've seen each other, but we would text each other here and there and blah, blah, blah. And it was during COVID. Andy came out to my house in the suburbs in Chicago, and I have this big 8-acre backyard, and he was coming in from
beautiful home. You're all domesticated with the pool and the barbecue.
Yeah, well, that's me, man. That's me. But we were going to just kind of compare notes and catch up. It's during COVID. We'll sit on the back patio and socially distance. Well, I go buy a good bottle of bourbon, and you know, Andy announces to me that he doesn't drink anymore. And I'm like, well,
I did give that up.
Yeah, I'm like, well, more for
it
me.
Had its place in my career.
Well, first of all, I was thanking you because more for me that meant, buddy. Anyway.
Well, you were a fantastic cook too, because you remember that you made those huge steaks.
Oh gosh, yeah, I was involved in a steak business at the time, and we had some excellent steaks.
That's right. And I don't know if you would say this, John, but we've compared net worths over the last decade plus, and we've both exploded.
Yeah.
But it was like when we were lower net worth, our ego was bigger. We had something to prove, right?
Right.
And you meet those guys, and they know everything.
Yeah.
And our net worth, we know we're considerably higher, but they want to prove to us that they're right. And we're at a stage in the game, right? We kind of know we're right, and we don't need to prove anything, right? Do you feel that?
That's an interesting point right there. I think things like that used to bother me a heck of a lot more. Gosh, I remember when I was first getting started, I hadn't sold my company yet or anything, so I was just accumulating wealth from saving money, from just putting away cash flow, and I was probably, I don't know, somewhere between 2 and 5 million net worth at the time, but I still never would overdo it. I would drive an Infinity maybe because I didn't want my clients to see me like showing off in a Mercedes or a BMW or whatever.
Yeah.
But then I'd see other people like driving Ferraris, and it would kind of bother me. I'm like, this dude has 2 roommates in the city. How the frick is he buying this damn Ferrari? And it would kind of bother me. But now I'm looking at life. It's like, dude, who gives a shit? Like if people want to spend their money on that shit, let them spend their money on that shit. You know, like in Chicago, boating's a big thing. Like it's like the cool kid, scene kind of thing. And for me, it never made any sense. A, I don't really like boating that much. And B, we're in frickin' Chicago. What do you think, like the people that live in Fort Lauderdale or Miami, do you think they're like envious of the Chicago boating scene? We're a bunch of frickin' douchebags, you know what I mean? Anyway,
good way to put a lot of money into a hole, a pit. I agree to you. I think a lot of those people, like I get that grief all the time. Like, why don't you fly private all the time? Which I don't. And I'm like, my time isn't, it's valuable, but not enough value there. And I feel all those dollars that we spend, I could put that as a down payment on a deal. I could invest. You're like me. Like we would live a good life, right? We're not living cheap. But if I have a $10, I don't want to put it on a private jet or buy a yacht. I want to put
Yeah.
that towards the next deal that's going to give me $10 return on my money.
I will say though, and then we're gonna get off this private jet thing, but the ownership, they're owned by Apollo now, the private equity firm, but prior there was a family that owned the Venetian and Palazzo Hotel. Okay, and that family has like 30 different private jets, maybe more. And over New Year's Eve, I got invited to get on one to come out to their casino. It was kind of like a high roller kind of thing.
I
Dude,
saw the picture of that one.
brother, it was a 737 Boeing business jet. I mean,
I saw the video of that. That's a different level.
I will get on that thing any day of the week, bro. Okay, it's like freaking
9-figure plane.
that was insane. That was insane. So give me that private jet, and as long as I don't have to pay for it, I will go on that any day of the week.
Yeah, that's a lot.
Anyway, you know, what it comes down to also though is my time is important to me, but I usually don't have to be somewhere on a time sensitive piece of, like, you know,
right.
what I mean?
And I get the business guys, like, you know, a lot of people, they're on jets all the time, but they got to be here. Like my buddy Dean, I mean, he sometimes has to be in 4 states in one day. You need a jet, you know, he ain't doing commercial.
If there is a business purpose to doing it, yes. If your net worth is under 10 million and you're taking private jets everywhere without any business associated with it, you're a fucking asshole, right? So I swear.
And I would even add another zero, you know, a few zeros to that. Yeah. I would say it's a lot of money.
Let's shift here, my friend. You started out with single family homes. There's an interesting progression you had, Andy, and let's segment this, okay? Because I know me personally knowing you, and now I'm telling the audience, Andy played hard in that single family home space as far as being a landlord. Then he transitioned to multi-unit apartments. Now he transitioned from there into commercial with a focus on healthcare. Andy, why don't we start with single family homes? And then we'll end that segment with you telling us why you left it. But how did it go for you in the first place?
So, yeah, right at the beginning, my first real estate deal was I was 28 years old. I read Rich Dad, Poor Dad, and I just said, how much money do you make while you sleep? And I was like, I was making good money, but I was spending a lot of it. And if I was sales, I was knocking doors and selling windows. So at 28 years old, I'm like, I got a $250,000 house, new Jeep, Corvette, Rolex, Wave Runners, all the toys, right?
Yep.
Well, if I got hurt for 3 months, all toys go away. Yep. So my first deal was a $55,000 single family home. And it was a good investment. You know, I put like $5,000 down back then. But the issue with that is you got one tenant, one deal. It goes dark, which mine did. You know, the tenant moved out, blah, blah, blah. It doesn't pay. You got one rent, and it was, you know, like $600 a month house payment. Long story short, I did a few of those and then realized these damn tenants don't stay forever. And then one tenant could be $10,000 in damage. And I got into the apartments because multifamily, you know, it's one roof for 50 units or 100 units. At one point in my career, I had 174 single family homes. Now that may sound great. Yeah. That may sound great and awesome, but some months we were losing between $40,000 to $50,000 a month in cash flow. Because like if you have a single family home and it needs a $10,000 roof, but the place is cash flowing $150 a month, how long is it going to take you to get your money back to get that roof done, or the HVAC, or a plumbing disaster, or electrical or furnace, right? So the apartments are nice because you could spread it out more. The single family home was great when we flipped houses. I flipped 1,000 homes in 5 years, and I would never do that again. That is, I mean, you're talking hundreds of contractors, and you're talking a 70-hour work week and a lot of involvement. You know, we were flipping 200 houses a year.
So let's backtrack for a second. So when you were the landlord on 174 of them, this was pre-2008, I'm assuming, correct?
You know, actually, it was right during the 2008, because the 2008, 9, and 10 is when the world went crazy, and that's when I started buying. Because I was only apartments, and then 2008, they got that $60,000 home. Now I was buying it for 40. So honestly, 2008 was one of my best years of my career until the pandemic hit.
I see. Okay, well, we'll get to that too. So, but
Yeah.
okay. So I think our audience is all wondering then. Okay, so where did this capital come from, Andy? Because
Well, the capital came from I had several businesses that threw off some income.
okay,
But over those previous years, I started investing in like 2002. So those 6 years I did, which is crazy to think about now, I saved up the 25% down payment, bought like $1 million. My first deal, a big one, was 1.3 million. And in 6 years it was worth 1.6 million, and then I only owed 800. So it was the debt reduction that I recapitalized that and put it into all the down payments on the houses. So it's the apartments and the debt reduction is what kind of floated me through that.
see, I always wondered though. Okay, so once you get beyond though that maybe third or fourth house, even if they're only that kind of price range, and their investment properties in addition to your primary residence, right? Even if you have that down payment, aren't you running into issues with bank approval, or was this before all the mortgage
No,
companies changed their way of thinking?
no, it was still challenging.
Okay.
2008, 9, and 10. 2008 was when I bought my very first strip mall, my commercial strip mall,
Okay.
and 12, and I had already had at that time, 2008, I had about 700 apartments at that time.
Okay.
In 2008, I bought my first strip mall, and the bank was like, "You're crazy. Why are you buying a strip mall, mom and pop restaurants? And if it goes dark, you go from cash flow from say 5,000 a month positive to 10,000 negative." So that first commercial deal was 2008, and 12 banks turned me down.
Okay.
12 banks said no. And I already had 700 apartments.
Wow.
So it's a little variation. In buying all the homes, we were buying like fixer up homes where they were literally like 40, 50 grand, put 20 grand into remodeling them and then renting them out. And then we started selling them as packages to investors. So we kind of did the flipping business a little bit different. We didn't do retail flips. We sold like guys like you that have money, they don't
Yeah.
want to buy three $40,000 houses. But if you give them 10 $80,000 houses that they each pay $1,000 a month in rent and you handle their financing, guys out of California,
Yeah.
they were eating up those homes like crazy. So that's why we were flipping so
And
big.
you were doing that. Okay. So here's what's really interesting about you saying that right now. Anybody that's watched the news the last year or so, they're talking about these private equity firms scooping up houses
Yeah.
and make like pricing people out, where in some communities they can't even buy a house because they're competing with private equity firms that are coming in there with cash. I've seen a couple, I think maybe on 2020 or 60 Minutes or something, did a whole thing
It's
on it.
happening across the board.
Yeah. Yeah. So
They have
you,
so much capital. They're just
mhm,
putting it like Grant Cardone buying deals at like 3 and 4 caps right now.
yeah,
Blackstone 3 and 4 cap rates. Like they just have
mhm,
so much cash. They're moving it. The
yeah.
market is different for sure.
So what? But you were doing this 10 plus years ago, and you're who were the investors? Were they individuals? Like, so I
They were
so I just
They were
want.
mainly individuals, and there were
Okay.
individuals that we'd met at like masterminds. Like I
Okay.
got into my first mastermind in strategic coach in Canada
Hmm.
through Dan Sullivan,
Yeah.
and we had to go every 90 days. We met a lot of great people. So a lot of it's just been relationships that I've made over the years,
Yeah.
good, bad, and ugly, but they're all relationships from events that
Yeah.
we're all just trying to go to that next level, and the next level just keeps changing.
So let's talk about that for our audience. Okay. I'm gonna say you're an individual investor, and you
Mhm.
buy your first, fixer upper. It doesn't even have to be a fixer upper, but you got a rental property under your belt, and you take a home equity line of credit and you buy a second one, and then
Yeah, that's
then you flip on one and you make an extra 100 grand and use that money to buy a couple more. At what point in today's market, Andy, could someone get to the level, what's the quantity or how much cash needs to be flowed off of these to get the attention of a potential buyer to come in and buy it as a package? 100, 1,000, or 10?
Today it's different. Back then we were able to sell to 10, but these big
Okay.
guys now, you need to have packages of 25, 50, or 100.
Okay.
So,
Okay.
and talking about the HELOC and all that, that's a questionable spot. I never really did that. I mean, I did the slowest way possible. I saved up the money, bought the deal, saved up the money, bought the deal, sold the Corvette, bought the deal. That's what I think in 2008 hurt a lot of people. They got their mortgage on their home was 130%, but they bought 4 rental properties. And then all 4 go out, or $28,000 in plumbing, whatever. I
Yeah.
think that got people in trouble. I never really crazy leveraged everything. I
Yeah.
always try to keep my leverage around 60 to 65%.
Yeah.
If you get beyond that, it's just if there's any problems, you can't float the problem and you'll lose everything. And that's exactly what you started with. It's
Yeah.
just greed.
Yeah, I benefited drastically around that time. My core business, insurance, had focused on private colleges and universities. And for those that aren't aware, what often happens during a recession is that higher education institutions thrive because people can't get jobs. They decide to go back to college. And that's exactly what happened. So I kind of felt bad. I think we were up to like 14, 15% or whatever it was unemployment rate. I had good friends of mine that were, making 200 grand a year 6 months ago. And now they're, not. And, in the meantime,
but they still have all the expenses of a 200 grand income.
Precisely. And here I am, like literally thriving because I had this niche focus on higher education institutions that were just growing and growing and growing. So it really put me in a great spot to do things. And I had other income streams too. But I gotta say though, some people, going back to that crisis, some people made the conscious decision to walk away from their homes just because they were so far upside down. It's one thing on an investment property. Some people decided to do it on their damn primary residence. I could tell you, I'll use my brother as an example. He did not do that, and a lot of people in his situation would have. Him and his wife bought a nice townhouse, and it's probably close to 400 grand or whatever. And a year later, all that shit happened, and it was probably worth every other house in their damn subdivision was for sale. Well, screw this. Let's start over. We're down 180 grand. It's only worth 220 now. We paid, they waited it out, man. They waited it out.
I think that shows to their character and integrity.
Yeah,
Obviously,
yeah,
I've never let a property go back to the bank ever, and never will.
mm-hmm,
That just talks about who you are, who I am, and as we grow, our character and integrity is all we got, really. Because we're going to have bumps and bruises. So that says something about your brother. That's fantastic.
Yeah. And even when I think they ultimately never even got back there when they ended up selling it, but they weren't upside down on the mortgage because years later they kept, paying down that principal. But they definitely
principal reduction.
Yeah.
Principal reduction will bail me out of anything, and that's what people don't realize. Real estate is not sexy. Mm-hmm. It is boring. Yeah. It is slow. It is slow, but over a long period of time, let's say you way overpay for a property or you make some big mistakes, it will cover itself. Yep. You just got to kind of stay in for the long term. It's not the get rich program at all. As we know, we can invest our capital into businesses, which I had many businesses and hundreds of employees that I don't miss at all. With my real estate portfolio, I have no employees, so I don't have to manage anybody. I don't manage any of my assets. That is something I can't get from a business. So I could spend a year in Hawaii if I chose to.
Yeah.
But the time is more important, I think, than anything when it comes to real estate. It is a hands-off experience.
So I think that most people understand, or if they don't, they could figure it out pretty quickly. Okay, I'm trying to rent out a property I own. Okay, what are my damn expenses? And they could add up their homeowner's assessment, their taxes, their mortgage. Maybe I say the principal's going towards you. You don't even have to add that in to break even. Potential maintenance, different ways to look at things. You could probably figure it out. I don't think people understand, Andy, if we transition now to commercial space, how do
whole different beast?
Yeah, how do leases work on commercial space?
So here's the reason I got into commercial so heavy. So at the age of 39, I'm 46 now. I completely retired. I got lazy and gained weight and drank a lot of beer, to be honest. I spent a lot of my time in Miami. But anyway, I had a lot of
and now he doesn't drink and he's in Iowa. So what happened there?
Yeah. Well, I'm headed to Chicago as soon as we're done. So, but anyway, I'm in my Iowa home now. Yeah. But anyway, so we had these apartments, right? I had about 700 apartments, and I had 2 properties. One needed a new flat roof, and that was $250,000 for the flat roof. Another one needed a parking lot. And the parking lot was about 250,000 too. The problem was it was a 70-plex and a 56-plex. And this was back 5 years ago or 6 years ago. And the problem was I couldn't raise the rents enough to justify that because I was like, the roof's leaking. I got to put it on, right? Those tenants are not going to give me my 250,000 in capital back, and the parking lot's the same story. So I sold everything I had in all of my apartments and transitioned to commercial because commercial triple net leases, I don't pay for all that stuff, but that's all the stuff you dig into. Now I read a lot more paperwork and leases,
Okay.
but like inflation's crazy, right?
Yep.
So let's say our lawn and snow is way more money.
Okay.
Well, I don't pay for those expensive lawn, snow, water, lights, power, HVAC.
On a triple net, you don't pay. Who doesn't pay for the
It's the common area maintenance charges are picked up by the tenant. Obviously, you got to dive into the lease before that's why I spend a lot of my time is studying leases, which is not sexy.
Right.
But it's really before you acquire the property because there's a gross lease that just says, hey, they pay $10,000 a month. But 99% of all of my investments are triple net.
Okay.
So whatever the lawn, snow, property management, everything that can go up and that's physically can change in price or like roof or windows, that's on the tenant's responsibility.
Okay. And what is the triple net? What are the three things?
It's called CAM charges. So your common area maintenance charges.
Okay.
Which may be your snow, lawn. Oh, a big one. Property taxes.
Okay.
If my Moline property that I had at 870-plex, property taxes go to 100,000 a year from 50. Are the tenants going to pay me more money? No.
Okay.
On a triple net, I don't care if the property taxes go to $1 million a year. Not my problem.
Okay.
Because it's on the tenants. Now we obviously fight the taxes and we try to keep expenses as low as possible.
Yeah.
So we can be as efficient as we can as a landlord.
Right.
But those expenses are all on the tenant.
So is that talking about just the increase, or does the base lease already consider where they're at right now? And then
the base lease is the base lease. Let's say my property is $20 a foot.
Yep.
Now the expected common area maintenance charges might be $10 a foot.
Yep.
Now this year it may be 10, so we're going to build you the 20 plus the 10, 30 a foot.
Got it.
And then at the end of the year, we do a reconciliation of how much was the snow, how much was the lawn, how much was lights. How many repairs do we have to do to your parking lot?
Yep.
How much was the property taxes? So at the end of the year, it may go, hey, we got it done for $8 a foot versus 10. Yay, I owe you money. Or it goes to $12 a foot.
And we got listeners all over that are residential landlord investors being like, shit, I wonder if I could do that to my tenants. That would be awesome, man. Hey, my property taxes went up with the Trump Tower. You owe me an extra $6,000. How you doing there, buddy?
Right.
Yeah.
Exactly.
I mean, I know it'll vary, and I know that would be the answer normally to this question. But what's standard operating procedure in terms of, hey, I'm going to buy this existing strip mall. The current landlord of the 8 units that are in there is cash flowing X. Would it be a multiple of that cash flow you're going to purchase it for plus the principal? I mean, how?
Yeah, so that's a fantastic question. Yeah. So how we base it is, say the strip mall's for sale, this developer wants to sell it. Yeah. I take the current rents, like if it's at 60%, I'm only basing it on what rents are coming in.
Okay.
So let's say I want to buy that at the deal today will be a 7 cap rate. Okay. It's all based on that deal.
And explain, some of our audience is going to have varying degrees of understanding here. So for our audience, explain exactly what 7 cap rate means, please.
It's just like if you paid all cash, that would be your return.
Okay.
Like if you buy, mainly people were buying Walgreens. A Walgreens was like a 4 cap, right? But if you paid $5 million, you'd give them $5 million in cash. Your net operating income, your net cash in your pocket would be, say, a 4 cap. It'd be like $200,000.
Okay,
so it's just your return on your money
per year. That's the return, correct?
Yeah. Of course,
$5 million turns into you get $200,000 off, $200,000 off, $2,000 to you each year, and then eventually you sell it for $5 million.
Yeah, and it's going to be worth $7 million. Probably.
Okay, gotcha.
All on average, our properties went up 7.4% last year, 8.6% the year before. That ain't continuing. I think I budget my portfolio, like my $128 million portfolio, I think it's going to go up on average about 4%. Well, 4% of that is $5.2 million a year. And then my debt is paid down by about $3.5 million a year. So I get 9 million a year in growth, right? But it's still not sexy. It's not throwing millions of dollars in my pocket.
Right.
But long
Right.
term, it'll grow my wealth.
Yeah.
And it's slow and consistent and boring.
That's
So the other part when you negotiate that deal
yeah.
is when you negotiate the purchase, like several of those deals I did, you may have to put 30% down. You may have to put 40% down because it's all based on a debt service coverage ratio, your DSCR. So like the bank wants to see a 1.25 DSCR. So say I buy that building at $3 million, I put $1 million down, I owe the bank $2 million. It's got a debt service coverage ratio of 1.25 or more. So there's just room for error. So that's where you may have to put 40% down.
What's the math in that example right there? So
it's just the debt costs you $10. Well, the property needs to net 1.25 of that, so $1,250.
okay.
So it's
Okay.
just the net. So now what we do in commercial is all net. The not downfall, but the challenge in apartments is, which I love apartments. I had almost 1,000 of them. I only got a couple of hundred now, but you can fluff that. Well, snow was $8,000, maybe it was 10. Utilities were X, maybe that. I had to rehab 20 apartments, but maybe it was 40. There's fluff, right? But commercial, there's no fluff because I don't pay anything. If I tell you it's a 7 cap, it's a 7 cap, not a 7.1 or not a 6.9. Apartments are tough because we all know you can fluff stuff. How do I know exactly how much repairs and maintenance? On a commercial deal, I only go by net operating income. So there's no room for fluff. I don't care about if it needed a 400, like I did last year, I put on $1.6 million in roofs, all done through insurance or tenants. I didn't pay $1 for that 1.6 million. Maybe 25,000, I think, of deductibles, 5 deductibles. But the tenants and the insurance, that was all paid by not me. So it was 1.6 million in value that I got, but I didn't pay for it
Okay.
because it's all triple net.
Gotcha.
So it's a different playing field. But like I said, you don't want to go into commercial until you have a net worth of, my personal opinion is at least $10 million, I would say.
Okay.
Maybe 5.
Even for like smaller strip malls that you might see around town.
Well, here's the problem. You just got to be able to cover it. Exactly what you said earlier.
Okay.
You got to be able to cover it. You got to have other forms of income.
Yeah.
Because let's say you buy a $1 or $2 million strip mall. I've had this happen many times. And you got 2 tenants that are $5,000 a month. Well, they both move out. They go bankrupt. Whatever. Happens all the time. You got to cover that 10 or 15,000 a month. You got to cover the bank, the taxes, all the expenses stay.
Yeah.
I just don't want people to think you can get into it because, like, I have tenants. Probably the least expensive tenant I have is probably $4,000 a month, but I have one tenant that pays me $100,000 a month.
Okay.
Imagine a guy moving out that pays you $100,000 a month. That's a big bite that people aren't going to take.
And the leases are set up in a way where, if that company goes out of business, they go out of business. You can't recover that money. It's gone, right?
It's gone.
Yeah.
That's a risk you take. Now, here's the difference. The tenants that I have now. So when I first got into commercial, dude, it's so different as our life evolves and our experience changes, right? So I bought strip malls that were like, back then it was like 8, 9 cap rates. Good return. I'm getting rich at 8 or 9. But that was like a mom and pop nail salon, a mom and pop restaurant, a little accounting office. Half those went bad. So they didn't work. Like my tenants now, a lot of my tenants are like, say, University of Iowa, Genesis Hospital, Trinity Hospital.
Yeah.
A lot of big hospitals and universities, because guess what? They have $1 billion balance sheet.
Yeah.
The $1 billion balance sheets, I'm buying those at a cap rate much lower. My Walgreens, my Buffalo Wild Wings, low.
So let's talk about that for a second, okay? Because I was going to get to that. All right, the best kinds of clients. All right, these large healthcare organizations, these big,
behemoths,
systems. You made an interesting point earlier. Okay, the hair salons, the nail salons, the mom and pop laundromats. The people coming and going. And if I'm an investor and I see on Dundee Avenue this, strip malls for sale for $800,000, and look, I'm looking at it. I mean, dude, I could pull this off, and I'm just trying to side hustle this bad boy, and I got a couple $100,000 as a down payment, and a bank finances the rest. I mean, there's probably I wouldn't know. I'm not talking about me, by the way, everybody. But I wouldn't.
I know you know. We talk about that.
I wouldn't know what I wouldn't know, right? I wouldn't know
you
what
don't
I don't
know.
know
What you don't know.
Yeah, and it feels like It's almost like what I'm doing right now in early stage venture capital, whereas like, dude, this could go a lot of different ways, and
Yeah.
many of the ways ain't good. Okay, so
But those are the bigger returns. Like
well,
those will give you a bigger return.
but here's the analogy I'm making though. If I'm in 20 of those deals, right? And I'm gonna, a lot of them are gonna go out of business. A lot of them are gonna break even. I'm looking for a few of those to hit that home run. If I was only in one damn venture capital deal early stage, that's like betting the frickin', black 14 on a roulette wheel. You know what I mean?
That's like throwing darts at a board, my friend, and we
Yeah.
don't throw darts at a board.
Right. And you only have one dart to throw, right? With your eyes closed.
That's why I say don't get into commercial.
Yeah. Well, that's what I'm thinking now, the way you're saying this. If somebody scrapped together some money and wanted to side hustle this thing and say they're a dual income, they make a couple $100,000, they've saved some money, maybe they have some inheritance money from a parent that passed away. And, they try to buy that strip mall and they think it's a good deal because they like going to the 7-Eleven that's in it and that's a good tenant. They ain't going anywhere. Your advice would be don't even mess with this shit.
Don't even consider it. Get into an apartment deal because what happens there is a lot. They save up that $200,000 and that's all the money in the world. And they're excited because they bought $1 million deal.
Yeah.
Well, what happens a lot of times is then both tenants or 3 tenants all go bankrupt or they just don't pay. Whatever it may be, right? The world is protecting the tenant. So then boom, they got the $200,000, they got nobody paying. So what happens now?
Yeah.
Now the property that they bought for $1 million, they put 200 hard-earned $100,000 down. Boom. Property now is worth 500.
Yep.
So
because the tenants left, it's innately worth 500. Okay.
If you're lucky and you owe the bank 800,000.
Yeah.
So that's where I have came in and I bought a lot of those deals where I'll come in and just buy that deal for 500,000 all cash from the bank or that struggling person that mortgaged their house to get rid of it off their plate because they're losing 15,000.
Okay. But it's only worth, in that example, 500 to you, Andy. You would have to turn around and go find tenants, correct?
I got to go spend a year. I got to cover the 500. I may have to do TI improvements. Yep. I just did a TI improvement that cost me $1 million build out.
Okay. Gotcha.
On the big stuff, the TIs eat you up. But yeah, don't do that. It can eat your lunch. And that's why I know why the banks in 2008, 12 banks turned me down because they were smarter than me.
They knew what you didn't know, right?
Right. Yeah. And as we grow, like I've taken so many courses on real estate. I have CCIM, I have my broker's license, I have every license. But anyway, the education you get from screwing up and making big mistakes is worth way more than money because over time it'll pay for those sleepless nights. And I had a lot of those strip malls. I mean, don't get into those. I would say my number would be $10 million net worth.
Okay. Well, and another interesting point about that, and this is more just, I think, society in general than specific to a strip mall, I suppose, but not everybody has the same character. You see, you mentioned tenants just walking away or not paying. Dude, listen, man, even if it seems like your best friend, hey, you guys have this great relationship. Hey, that guy's pizza joint ain't making any money this month or the next month. He might sit there for 4 months, keep the $1,500 in rent instead of paying it to you, and then just walk away. You're screwed, man. No, Mike.
And not even think about it.
Yeah, man.
The ones closest to you I have found will screw you easier than a complete stranger or a friend that you talk about finance. We talk about upping our life and upping our credibility all the time. Not everybody at the bar at 4 p.m. at Tavern on Rush is talking about that.
well, and it's also goes to the fact that that person that has that independent store that maybe is one of your tenants in that strip mall, and he goes out of business or whatever. He's looking at you. You're the big bad landlord, bro. I
know. We're always the evil guy.
Well, you're the baller, man. You're rich. And Andy just pointed out, no, you're not rich. You're the opposite of rich in that scenario.
I am not rich.
Yeah. That's totally.
Well, we just had my attorney and my property manager had to go to court on Tuesday, and it was an accounting firm. Like, think about that. An accounting firm. I can't mention any names, but an accounting firm. They're perfect, right? They're all perfect, right?
Right.
I mean, but they haven't paid their rent in like 6 months. And what happens is they file BK. So what happens? All that 6 months of rent is gone. Now we cannot turn off power. We still have to fund this massive utility bill. And I will never see a dollar but they're an accounting firm or whatever. It's just amazing where they won't think twice and they will just bail, and the court system will protect them that Andy won't get paid anything. And I'll have $10,000 in legal fees on that deal. And I still got to keep their power on and everything until it's done.
You made a good point right there, man. And earlier you used the term, I wrote it down. The world is protecting the tenant, and I think you just showed us why with those words, man. So if a person, and let's wrap up here shortly, but Andy, you obviously are a subject matter expert in this. You've done some things. You've made some moves. Let's back up and leave the audience with some advice here. Okay. I want to get into real estate investing. I got a W-2 job. I'm not rich. I want a good side hustle though, to bring in some extra income. I don't have these other income streams that are paying me out my ears like you did with your landscape business when you got in this space, Andy. So I can't go buy hundreds at a time. What are the dynamics I should look for something to even just help me supplement my my lifestyle?
Well, the best advice I have is what I always tell young investors, and I do daily, is this: don't get into anything that can crush you.
Okay.
Don't get into anything that could just take you out of the game.
Okay.
So make as much money as you can in your day job, but then also go to masterminds, go to groups, go to events. Biggest takeaway for me has been masterminds. You just meet so many like-minded people, and you may meet some people that there's 4 of you. I would say 100% without a doubt, masterminds and like-minded people, but also go into apartments. Don't go into a 50 or 100 plex. Start with a 4-plex, a 6-plex, where there's some diversification. My flight instructor right now, he's like all excited. He's going to buy a 4-plex. I'm like, he's 27 years old. He's going to be rich. He's going to be killing it. But just start where you can absorb. Like if that goes half empty, can you still afford it? And you're not going to be, losing your mind. So get in like-minded rooms, masterminds, and I would start with apartments and consider getting a group of. Now, I don't do partners, and maybe that's why it's been so slow for me. I dabbled in real estate. Partners are not really my thing. But at the beginning, I probably should have, because I could have gone, we'll go far alone, but we'll go farther together,
Yeah.
And you got 2 like-minded people. Like if we chatted 10 years ago, we may own $1 billion in real estate. We're just like-minded.
Right. Well,
so get in those groups, I think.
I love that. And you had said that make sure you're able to weather the storm. And earlier you talked about selling a Corvette. Listen, man, if you're spending your extra money right now on a country club membership, if you're spending it on a Mercedes and a Range Rover for your wife that you or your spouse that you couldn't afford, and you're stretched, man, and you're also trying to save for college, don't fricking try to turn around and buy a 2-flat on top of it, brother. Okay. Maybe take the money that you're spending on all the bullshit I just talked about and go buy a 2-flat with that money. Now go buy the 2-flat with that money. Just don't go to country club anymore, whatever.
Right. I agree.
Unless you're living beneath your means. And I think that's what Andy is ultimately saying here. Have enough fluff there to weather the storm. And it doesn't mean just 3 months of savings in your 3 months of expenses in your savings
right.
account. You're talking about an investment that could go south. We started off the show talking about everything that went wrong in 2008.
Right.
I encourage anyone.
It goes back to what you said, the greed thing. We always overestimate what we can do in a short period of time, but we always underestimate what we can do in a long period of time. Right. Try to build your portfolio not to get rich quick, but to get rich for sure.
Yeah. Well, I think you're giving some sound advice, my man. And I'm going to tell you what, if anybody wants to be scared to not invest in real estate, I think Andy gave some advice on maybe what you should look out for, but he's not telling you not to.
Absolutely.
Go watch the movie The Big Short, and you might want to stay away from this shit altogether. Okay, just go watch that movie if you get a chance. I invest in real estate, again, not to the extent that Andy does. There's definitely a reason that so many people do it, but like he just specified, it ain't easy. Andy, could you tell everyone how to find you, my man?
I would say the best way is just social media, my Facebook and Instagram, Andrew J. Sallee, Sallee. And thank you, my man. Always good catching up with you, dude.
Thank you, everybody, for listening today. to 2000% Raise. Thank you for tuning in to 2000% Raise. You can check out more episodes on YouTube, Apple, Spotify, and your favorite podcast apps. Check out the show notes for any websites linked to this episode. I appreciate you tuning in. Remember to like, subscribe, and turn on your notifications, and visit me at 2000percentraised.com as well as at John Cerasani on TikTok and Instagram. I genuinely appreciate you dropping by.